My name is Jake, welcome to the channel. In today's video, we're going to do another Review My Pie video where I review subscriber portfolios. If you're new to my channel, I am in my mid-30s. I live down here in Austin, Texas. My wife and I, we are looking to achieve financial independence and retire early, so we follow the FIRE movement by our mid-40s. We invest for cash flow. We invest in a dividend growth strategy so that we can live off of the cash flow or the dividends from our portfolio in early retirement. I created this channel over a year ago to help inspire and educate new or beginner investors learn about investing, learn about the importance of investing and how just your average Joe can do it. You don't need a financial advisor. You don't need a financial planner. You can do it yourself. So in today's Review My Pie, we're going to review 4 subscriber portfolios. We're going to review the first one that is from a 45-year-old located here in the United States. The second portfolio is from a 26-year-old that sent over his spreadsheet from the UK. Portfolio 3 is from a 16-year-old. I kid you not, a 16-year-old. And the email, I just took a brief glance at it. The kid can write better than I can. It's insane. And also from the United States. Portfolio 4 is 34 years old, exact same age as me, also here from the United States. Very important disclaimer, everybody. This video is really just my opinion on the portfolios. It is not financial advice. Nothing in this video should be considered as professional financial advice. It's just merely for your entertainment. As always, I do not review the portfolios before reviewing them, so keep that in mind. I'm seeing the portfolios for the very first time when I review them. And as always, the timestamps will be in the description below, so if you're just interested in one or the other portfolios, you can go ahead and you can skip ahead to those portfolios. And if you're interested in booking one-on-one time with me, I created a website here where you can do so. You can go on the site and there's different topics that you can choose from. So from sales interview prep, role playing, resume coaching, and M1 finance coaching and pie review. So this is not where I'm going to give you financial advice. I want to be very, very clear. If you ask me, hey, should I invest this? I'm not going to answer that because I'm not going to exchange money for financial advice. But if you do want to hang out, you do want to talk about stocks, you do want to talk about your pie, and you have questions to me about my portfolio, you can go ahead and you can schedule one-on-one time with me through the website. And if you click book now, it'll pull up a calendar with different times that are available, and you can click on the time that you would like and you can book it directly through the website. And then after the booking, it'll send you an automatic text message and email. And once I've reviewed it and accepted it that the time works, I will then send over a Zoom link where we can have an audio only or a video call, whichever you would prefer. I thought this would be a cool way to interact one-on-one with all of you and talk about investing. And once again, not financial advice. I'm not going to be telling you which stocks to invest in, but I will share, anything that you really want to talk about, how I analyze stocks, how I track my dividends, anything like that. If you're interested, I'd be excited to meet you. And who knows? This could be us.
You do that for me? Really? Yeah, I'd like that.
Who are you talking to?
It's Jake from State Farm. Sounds like a really good deal.
Jake from State Farm at 3 in the morning? Who is this?
It's Jake from State Farm.
What are you wearing, Jake from State Farm?
Shorts and a t-shirt. All right, everybody. So the first one is from Matthew. Matthew writes, I'm new to investing and have really enjoyed your videos. I'm 45 years old and opened a Roth IRA a couple years ago on Betterment. I didn't do much of anything with it other than add money whenever I had extra. I'm in the process of transferring it to M1 Finance where I can get away from the 0.25 management fee and have more investment options. My goal is to simply grow this account as much as possible for the next 10 to 15 years and then reassess depending on how I feel about retirement at that time. I don't think I have the time or knowledge to pick individual stocks and the winner and losers, so I picked a mix of ETFs that seem likely to grow this money and pay dividends. Here's what I got and hope you can take a look. Thanks in advance. Roth IRA pie with 4 pies equally weighted at 25% and 9. Okay. All right. So you sent over in a different email your link. Let's take a look at your portfolio. All right, Matthew. So you mentioned that this is in a Roth IRA. It says here in the description. So you're up 107% over the last 5 years, not considering the reinvestment of dividends. You have just under a 1.5% dividend yield. Your expense ratio is very low. and you only have 9 holdings. Okay, so you mentioned that you weren't comfortable picking individual stocks, so these are all ETFs, and it's weighted by percentage 25, 25, 25, growth, dividends, NASDAQ tech. Okay, so let's take a look. S&P 500, you said that? S&P 500, SPYG. Okay, so this is a growth, like just purely focused on growth. This is not your standard S&P 500 like the SPY or VOO, whereas although from iShares, this is just your traditional S&P 500. Okay, so you have a mix here. This is actually a really, really good ETF. This is comparable to the Vanguard Information Technology, or there's a few of them that are kind of similar, like the Vanguard VUG or a VGT. VGT is just focused on technology, whereas SPYG is focused on more sectors. So this is a really, really good ETF. Now, if it's in a Roth IRA, so it's going to be very difficult to live off of the dividends from SPYG. However, this is in a Roth account. I think your strategy here is you're unsure of what you want to do. That's what you said in your email. I think this could work very, very well. However, you have to understand that whenever you're investing and you're planning to liquidate or sell the shares, there's a little bit of market timing that comes into that. But as a pure investment, IVV and SPYG are very, very high quality ETFs. And looking at the next one here, NASDAQ and tech, yeah, exactly, VGT and QQQ. These are great ETFs. These are the highest quality ETFs. So for example, if I were to have, if I were to invest in a custodial account for if I were to have kids in the future, I would definitely be putting VGT into their accounts because it's such a growth ETF. It's one of the highest performing ETFs out there. Talking about VGT, it's just incredible. It's one of my favorite growth ETFs. QQQ is also a really good one that tracks the NASDAQ. And then the thing that's cool about QQQ is it's not just technology, it's the NASDAQ as a whole. So you got bio firms in there as well. So it's a little bit more diversified than VGT, though it does cost a little bit more from its expense ratio. So, but they're both really great. Growth, what do you got here? You got VUG. VUG. I promise I didn't look at this before. VUG, SCHG, and VONG. Okay. Yeah. Of these, I really like the VUG and SCHG. VONG. Yeah. I mean, the Russell 1000. I don't personally invest into the Russell 1000, but I think this is also a really good ETF from Vanguard. Dividends, you got DGRO and SCHD. Okay, these are great. These are absolutely great. So with DGRO, both of these I have in my portfolio. They serve different purposes. DGRO is a great dividend growth ETF. It has about a 2.5 starting yield, whereas SCHD has a little bit over a 3%. It averages around 3 to 3.5%. SCHD is more income oriented, where you're looking for income today. So what this means is, if you wanted to just live off of the dividends where you're 45 years old, you're looking to retire and tap into these at 49, you're going to be able to live off of the dividends with investments like SCHD, and you would actually need to flip this and have SCHD be the higher of the two in terms of the target. But what it looks like, I think you're setting up your portfolio so that you can liquidate the shares in early retirement. That's what I'm taking away from this. And also because it's a Roth IRA, you're probably not investing more than $6,000 or $6,000 a year. And so it's like, yeah, that's something that you really have to understand. And so I think it can work. I think it can work very well. If this was not in a Roth account, I think I would, with the tax implication that comes in there, it's a little bit less favorable. But because this isn't a Roth IRA, this strategy, this approach can work very, very well. Matthew, thank you so much for sending over your portfolio. This is great. You only have the highest of quality in your portfolio. This is a portfolio that you can go to bed at night and feel very, very comfortable and not lose any sleep at night. All right, the next portfolio is here from Amir. This is a very long email. Let's see if I can read it here really quick. So, dear Dividend Growth Investing, firstly, love your content. Thank you so much, Amir. I appreciate it. Keep it coming, especially the Review My Pie series, as it gives me an insight into other investors' strategies along with your input. My name is Amir. I'm a healthcare professional. I'll keep it vague in the UK, and I am 26 years old. I've started investing about 6 months ago and have already been able to hit $10,000 invested, which is fantastic. That is fantastic. Wow. I have this split over 2 specific portfolios, both of which live in an ISA, so which is a tax-exempt investment account in the UK. That would be like a Roth IRA that we just saw. The first one is diversified fund ETF portfolio, which I aim to try to significantly beat the market. Okay, approximately 9 to 10% average returns a year would be nice. I fund this portfolio with $420 per month, approximately $550, so pounds, excuse me. Growth and dividend stock portfolio, mixture of growth stocks and dividend stocks from both the UK and the US, which a slight bias towards growth stocks given my age and investing time frame. Very good. I fund this portfolio with $100 per month, approximately 100 pounds per month, approximately $130. It took me forever to stop saying euros after I moved back from Europe. So now I gotta, yeah. All right, your aims or goals here is to invest over the next 25 to 30 years minimum. Use portfolio 1 to pay off the mortgage early. Currently do not own a house. Leave the rest invested into retirement and possibly used to purchase property to rent out and create further passive income. Use portfolio 2 to help me achieve early retirement by late 40s, early 50s by continuing to reinvest dividends and switching investments in my later investing years to those paying a higher dividend yield, switching from a growth stock bias to a high dividend yield stock bias. It's also a really smart idea. I plan on doing the same thing, also for tax efficiencies. That's very, very important. You continue to write here, for both portfolios, I use a platform called Trading 212, which is the closest available platform to M1 Finance in the UK. This platform allows me to create pies and turn on auto invest to make investing automatic and auto reinvest dividends. Please give me any constructive criticism that you can. I've spent a lot of time and effort creating these portfolios and educating myself. I'm very excited to share what I have created thus far with my 6 months of experience. More than happy for you to include in your next video, and more than happy for you to also contact me with feedback if you wish. All right, let's take a look at your first portfolio here. You said your main goal here with this portfolio was to fund, to pay off your mortgage in 25 to 30 years. Okay, so let's see, you have about 15 different holdings in here. These are all ETFs. And so I'm trying to understand. So your main goal with this portfolio is to pay off your mortgage, or pay off your mortgage early. Okay. If that's your strategy, you have it broken up into equities, bonds, REITs, and commodities. Okay. So you're treating this portfolio as a diversified portfolio with a goal in mind to pay off your mortgage in the future. I think a lot of these tickers here are unique to the UK. Like I'm not familiar with a lot of these tickers. You know, you have the Vanguard S&P 500 ETF. You know, okay, yeah. So this is for the UK. First off, I think that this is incredible that you're taking the time to break this down. You're looking to engineer it. You look like you sound like you're somebody that has a very analytical mind when approaching a problem or a task, right? And so you're taking a look at this very holistically. And I think it may, my concern is I don't want you to over-engineer the strategy here. If you have a clear goal, your clear goal is to pay off your mortgage with this portfolio, I would make it very, very simple, right? Bonds, you have 12% in bonds and REITs and commodities. Like in all honesty, like 25 years, 100% equity is, in my opinion, the way to go. Like there's really, in my opinion, based off of historical returns, and we all know historical returns and no guarantee of future returns, but if your goal is in 25 years to pay something off, 25 years, it should be 100% in equities. You should be 100% in equities, and really a broad-based, you know, like something like the S&P 500 with low fees, really focusing on that. And in my opinion, I would not over-engineer this portfolio, because this portfolio, you're looking to sell it. You're not looking to live off of the cash flow. So what you want is tax efficiency and something that is growing exponentially and, like you said, beating the market. I personally, if I was in this situation, I would be 100% in equities, and I would keep it simple. I'd have 1, 2, maybe 3 different ETFs, and I would put this on autopilot and I wouldn't even think about it because your goal is so clear. In 25 years or 30 years, you want to pay off your house with it. The more you play around with it, the more diminishing returns you're going to have. So pick the best of the best and put all, like that's my opinion. We're talking about ETFs here. Pick the best of the best, put it all into 1, 2, or 3 ETFs, and put it off to the side and just completely forget about it. Put your investments on autopilot and then focus on your portfolio 2, which is your cash flow portfolio. That's my opinion. When we look at your second portfolio, your cash flow portfolio, a lot of these names here I'm familiar with. A lot of these are these are US companies. Let's take a look at how you have it set up. So you have Apple up in the top, you have Amazon, you have Microsoft, and once again, you mentioned that your time horizon is around 20 to 25 years. Okay, so having Apple in there, having Microsoft in there is a great idea. Having Waste Management, I love seeing Waste Management in here. Waste Management doesn't get the love that it deserves. It is such a great company. It's such a great dividend growth stock. All right, so you got it broken up this way. You got your shares, you got the sector. You, my friend, you are a dividend nerd like myself. I love seeing spreadsheets like this. This is great. What other tabs that you got down here? You got the target allocation. This is great. This is exactly what I was hoping to see. You have your portfolio target allocation. So you get 9% in Apple. With your target, with your time horizon of 25 years, I think that's fine. I would say maybe 7% as a max, but 9%, we're talking about Apple here. In terms of efficiency for the dividend, Apple is going to be a little bit better for a pure dividend play if you have 30 years or more, 25, 30 years. You got Unilever, you got Facebook in here, so you're either betting on Facebook paying a dividend, which I don't see it happening anytime soon, or you're going to sell out of Facebook. You got Visa in here. Visa is good. I think 4.5%. Yeah, that's a good percentage. Pfizer, you got Target, you got 3M, you got Pepsi, you got Realty Income. There's a lot of great companies in here. You got Shell, you got ExxonMobil down there at around 1%. That's good. Google at 2%. AT&T. This is a really good portfolio. So the thing that I love about this is you're not heavily skewed in REITs. You have Realty Income, right? So you're optimizing tax efficiencies. You're well diversified in terms of your sector allocation. You don't really have really crazy sector allocation. So what I'm looking for is what percentage do you have in your highest holding? So for example, you have 21. In your case, 21 is completely fine. You could even go up to 25 if you wanted to, but 21, I wouldn't recommend going over 25 in your situation when you're with your time horizon. But this is a really, really good portfolio. What do you got here? You got the payout. So you're tracking your dividends. This is so great. I'm so glad that you're doing this. And I think it's so cool that you're tracking it this way. Like I said before, with Portfolio One, I think you'd like to get into the numbers, but I really would, encourage you to keep your other portfolio very simple and straightforward. And with this portfolio, this is the portfolio that you want to spend your time on, because it takes more time to follow up on individual companies compared to ETFs, and you're going to make your life a lot easier going forward. Amir, thank you so much for sending over your portfolios. These are great. I love to see that, people from all over the world are investing, and I just absolutely love this. Thank you so much for sending over your portfolio. All right, let's take a look at the next portfolio here. The next portfolio is from Jonah, who is 16 years old. You sent another email, Jonah. I have your email, and you sent me a different link to a different pie. So I'm going to use that other link, the new link that you sent. But you're right here. Thanks for the content you put on YouTube. It is very informative and enjoyable to watch. Hey, Jonah, thank you so much, man. The fact that you're 16 years old and you're saying this and you're watching finance videos on YouTube, it just blows my mind. This is so amazing. All right, so I hold around 70% in this pie and have a 30% position in Bitcoin. Okay, I know Bitcoin is a risky asset, but I've done my research and I strongly believe in its future. I think with my small amount of capital, I can have an oversized position in an asset class. Like, he's even talking about asset class. Holy cow, 16-year-old kid talking about asset class. This and be fine. But I'd like to know your opinion on it. I'm 16 years old from the United States, and my goal is to grow my money to eventually pay for all of my living expenses. This account is taxable, and I plan on retiring much before the standard age. So the standard age is 59 and a half, and 59 and a half is for retirement accounts. Standard age is about 65 in the US. I will probably keep it that way once I have my own account. I currently can contribute $240 per month with money I make from my landscaping business, and I plan on keeping that amount flowing to the account monthly or more if I can find more income streams. Man, you should start a YouTube channel about landscaping or something, man. You holy cow. I have a passion for economics and have been extensively studying the markets and macroeconomics in general for the past year. For this reason, I have some pretty risky investments in my portfolio, but I have a conviction for everything I put my money in. Generally, I can consider myself a growth investor with a healthy consideration on dividend growth rate, but I really just invest in companies' assets I have a strong belief in for the long-term future. I'm aiming to set my portfolio up to have the majority of my assets allocated toward a set and forget mentality and a small amount into some speculative investments based on some long-term fundamentals. In this way, I can still experience some of my growth ideas while keeping a strong dividend growth foundation to carry my consistent investments. Does this portfolio, 1, fit my before mentioned desired portfolio, and 2, act as a good strategic setup to compound my wealth to future freedom? Holy shit, man. Like when I was 16, I was playing like StarCraft and like, holy cow, this kid is like amazing. 16 years old. All right, so you write down here. All right, so you continue writing here. Here are some additional things I'd like to know. Are my allocations to stocks, ETFs well balanced? Generally, is my portfolio well built for my time horizon? Are there any simple improvements I can make to my portfolio? Okay, let's take a look at your FIRE portfolio, Jonah. So you mentioned that your ideal scenario would be to set it and forget it. So you really want to make this as passive as possible. You're 16 years old. You don't want to retire at the standard age of 65 years old. My guess is if you're 16 years old, you're one of the very, very few in life that will retire likely in your 30s. So this is the scenario. And I want to be very clear when I say this, the comments that I'm going to make, they're not going to be based off of a traditional, 40-year time frame, right? You're 16 years old, or 50, holy shit, math, 50 years, right? Like 50 years would be the standard age. So if you had 50 years for your investments to grow, like that's not what we're talking about here. We're talking in your mid 30s. So we're talking 15. Let's go with 20 years. I'm going to assume that you're going to retire in your mid 30s in 20 years. So your portfolio's performance over the last 5 years is up 62%. Let's take a look at it. You have a little bit of an expense ratio here. Not bad at all. Really, really good. Dividend yield of 1.486 and 52 holdings. You have fundamental ETFs. Man, holy shit, man. This kid is... Sorry, I actually realized I shouldn't be swearing. You're 16 years old. Holy wowzers. Holy crap. 60% in ETFs, 20% in individual stocks, 10% in macroeconomics. Let's be honest, everybody. Who knows a 16-year-old that even knows what macroeconomics means, right? This is just incredible. 10% income ETFs and REITs. All right, so let's take a look at your... So if you're 16, you can't actually open up a brokerage account. So I'm assuming that this was done by your parents, maybe in a custodial account. So this is probably something that your parents helped set you up with. That would be my assumption, because here in the US, you have to be 18 to have a brokerage account. So your fundamental ETFs, you have it broken up, also some other slices in here. So you got your momentum and you got VOT, Vanguard Growth Index ETF. Okay, what do you got in here? You got VPU, utility. Okay, yeah, utility could work. I mean, we're talking about 20 years here. VGT, VIS, VDC, and VCR. Okay. Yeah, I think that this could work. In all honesty, I would rather like to see VGT a little bit higher. We're talking about 20 years. Like, here's the thing. My assumption is that you're 30 years old. You're going to want to be financially independent, but you're probably still going to be busy. You're still, when we talk about FIRE, financial independence from retire early, I think you're the type of individual that's focused on financial independence and not necessarily retiring early. So you're probably going to do some other side business, some other thing to keep you busy, generate income. So you want this supplemental income. I think, focusing on the side of growth is really the way to go in this. When I'm looking at what you're writing in your situation, I think VGT, I think VOO, I think DGRO as well from iShares, the dividend growth ETF. I say DGRO instead of VIG from Vanguard because it is a little bit, it has a higher starting yield. It's not just it's growing its dividend quickly, but you're going to get a higher return quicker than with VIG. Individual stocks, what do you got in here? You got Square, you got Tesla, you got Waste Management, Disney, Visa, SPGI, McDonald's, MasterCard. These are all really, really good. JD, Lululemon, Starbucks, Spotify. So you got a few growth companies in here, which is completely fine. You got Accenture, you got Apple. All right. Yeah. I mean, this is completely fine. So obviously you're going to have to liquidate the shares in the future to get the cash flow from your investments. But these are all really high quality companies. I mean, here's the thing, Jonah, if you want a pure dividend play, like what I would recommend you do is I would split up your portfolio. In M1 Finance, you can have two accounts with your single login. So you can have a dividend focused portfolio and you can have a growth focused portfolio. Or maybe just split up the slices. Like you don't have to have a completely different account, but like split up the slices from growth, dividend growth, like companies that are paying a dividend, and companies like Square or Adobe here that are not paying a dividend. That would be my opinion. It makes it easier for you to focus on your goals. That's been my experience. Let's see. So you got artificial intelligence. All right, yeah. So these are really hyper growth. Nvidia, really, really great. AMD, great. Gold. Yeah, I mean, you could have it as a hedge. What percentage do you have in here? 50%. 50% of, so you have 5% allocated in the overall portfolio in gold. I think that's fine. If you want to invest into gold and have that as a hedge, I think that's completely fine. Income ETFs, DGRW, this is a really, really good one. DGRO, there we go. Noble, great, SCHD. These are all really, really high quality ETFs. You cannot go wrong with any of these ETFs. When it comes to the target allocation, I think you have it set up very, very well. With your time horizon, what you can always do later, like a couple of years before you reach early retirement, you can always adjust the target allocation to skew it towards current income, like SCHD and VYM. But right now, having it mostly in DGRW and Noble and DGRO, this is perfect. This is absolutely exactly what you should be doing for your age. REITs, what do you got in here? You got VNQ, PL. Oh man, these are amazing. You must be following my channel because this is exactly what I talk about. This is amazing. You got VNQ. There's a few other really high quality REIT ETFs out there that I have in my portfolio, but Prologis, American Tower, and Digital Realty Trust, these are the best of the best when it comes to REITs, in my opinion. These are really great. Okay, Jonas. So I just am in complete awe by what I'm seeing. It makes me kind of feel like, what have I done with my life over these last 20 years? I'm in my mid-30s, and man, you're light years ahead of me. So this is so amazing to see. I think some wisdom that I can share with you from doing this for a while is keep it simple. Keep it as simple as you can. You said that you want to set it and forget it. You have a portfolio where you can 100% set it and forget it. The companies that you have in here, the investments that you have in here, you could dollar cost average every week into this portfolio. And by the time you reach your mid-30s, assuming that you're averaging in and you're investing more every single year from side hustling, from cutting your expenses, cutting costs, you're going to be a millionaire, multi-millionaire in your late 30s. Like, this is absolutely incredible. You're one of those guys that truly understands the power of compounding interest and starting early. I'm so impressed, and just honestly, like, if you're ever in Austin, Texas, shoot me a message. I would love to meet you in person. Thank you so much for sending over your portfolio, Jonah. All right, the last portfolio here is going to be from Steve. Steve, you also sent me another email with a different link. So I'm going to use a different link from a different email. All right, so Steve writes here, "Hi Jake, I've enjoyed watching your videos. Thanks for sharing your insight and opinions with all of us. Here is my situation. Up until 2 years ago, school and my job situation did not allow me to save any money. Pay teachers a living wage in America." I completely agree. I couldn't agree more. "Thankfully, that has changed recently with my new job. By living frugally, I am able to put away between $1,000 and $1,500 a month. Holy cow. This year, I decided to get into investing and hopefully gain financial freedom someday. I'm about your age, so exactly my age. I'm 34 and have an investing horizon of 20, if not 30 plus years down the road. I've tried to balance my holdings between strong and steady blue chip stocks, as well as some semi-gambles with what I think are mostly safe big dividend equities that are currently undervalued, have room for growth, and are consistent and strong dividend payers. This is primarily a dividend-focused portfolio. Anyways, I'd like to know what you think if you'd like to take a look. Thanks. P.S. I'm not an Apple fan and I refuse to invest in things like Philip Morris and Altria." Okay, so absolutely fine. I mean, not everyone is going to, invest into sin stocks. Not everybody's going to invest into, fossil fuel, companies. Like, that's one of the great things about investing in individual stocks is you can pick and choose companies that you agree with, that have, that are socially or environmentally responsible. So, and also with pay teachers a living wage in America, I completely agree. I used to live in Europe, and the teachers in Europe were, when you would say, "Hey, I'm a teacher in Europe," like, you were proud to say that. You made a great wage and you had a great retirement package. It's night and day between Europe, at least in Germany, and here in the United States. And really quick, before we dive into your portfolio here, let me just share a thing that you can do. You said 20 to 30 years. 20 to 30 years, that's a 10-year gap. That is a long time. My channel is all about making money, saving money, investing, and really the three things that I talk about are cutting costs, cutting your expenses, cutting consumer debt, right? That new fancy car or credit card debt, and making more money. One thing that teachers can do or let's say if you got a new job, maybe you're no longer a teacher, but something that just average people can do is in real estate. You can do now I don't want to get off into a tangent here, but just your normal person to make more money, you can do it through real estate. And I'm not here to say that it's for everybody, but your average person, if you're looking to side hustle and you're looking to make more money, a lot of times you can do it as a normal person through real estate. You can buy a fixer-upper home. You can move into it. You can make it, you can repair a few things. You can paint the walls a little bit. You can do some landscaping. And 2 years later, you can sell it and pay no capital gains tax here in the United States. Like, that is one way that you can make more money and use that money to invest in your portfolio. So those are a few things that just are kind of on my mind right now, and things that my wife and I are thinking about doing. We're thinking about doing exactly that to make some more money so that we can invest more into our portfolio, so that we can generate more cash flow from our dividend portfolio. All right, Steve, so let's take a look at your portfolio. So you're up about 14% over the last 5 years. This does not count in the reinvestment of dividends. So if you look at the dividends, you have a higher dividend yield of 4%. So that's not factored into this performance, over the last 5 years. So that's important to note. You have 49 holdings and you have a very low expense ratio. You have your portfolio broken down into 14% into real estate, 14% in energy, consumer, Industrials at 13, healthcare at 10, utilities 9, tech at 9, finance 9, telecom 8. All right, this is a very well diversified, well balanced portfolio. I think the only thing that comes, top of mind that I see in this is energy. Energy is a bit high. If you're looking to retire in 20 years, the tax burden over those next 20 years from these energy stocks that are just trading sideways, that's something that you can consider adjusting. I personally, I think energy is a good, it's a good sector for current income, but given your circumstance, where you're at, I think you could skew it a little bit more towards growth. And so that's why I would recommend reevaluating the allocation in energy and lowering that. And what you could do is you could increase other areas like healthcare. You could increase, I'm trying to think, if it really is 20 or 25 years, you could increase technology. I mean, that's with your time horizon. I think energy is a little bit of a missed opportunity given your time horizon. Let's look what you have in real estate. You have Stag, Realty Income, LTC. So these are 3 monthly dividend payers. So it looks like you're skewing towards monthly dividends. I think you can't go wrong with this. I personally would recommend taking a look at some industrial, data center, and cell tower REITs. Some of my favorite are data centers like ticker symbol DLR. I really like cell towers like AMT, and I like industrial warehouse buildings. I like Prologis, ticker symbol PLD. And also some really good current income ones are public storage units. So companies like Public Storage. Let's take a look at your energy slice here. You have PBA, PBW, and ACES. So I'm not familiar with these two. This is an clean energy ETF. I'm not familiar with PBW, and I'm not familiar with this one. I am familiar with PBA. PBA, it's a monthly pipeline transport company out of Canada. 70%. I mean, that's It's not a growth company. Let's put it that way. It's more for current income. This right here would be more so if you're about to retire in the next couple of years. If you're about to retire in the next couple of years, this would be appropriate from a tax efficiency standpoint and a growth and a time horizon standpoint. But where you have more time, I think you should lower it. Consumers, you got Pepsi, you got Coca-Cola, you got Coke. Okay, so there's I'm not going to speak to this, but I think I'd have to do a little bit of research. I'm pretty sure I know what that is. I think it's like, someone correct me in the comment section below. Isn't this like the company that actually like distributes the bottles and stuff that Coke uses in their products? Something like that. Somebody correct me in the comment section. I can't remember 100% if that's correct. Coca-Cola, Kroger, great. Costco, Lowe's, Stanley Black & Decker, and Logitech. Yeah, I mean, this could work. So some of these consumers, so Lowe's, it's consumer discretionary. Stanley Black & Decker, yeah, they have consumer-facing products, right? When you go to Home Depot or Lowe's, right, you can buy products of theirs, but it's actually an industrial company. And so Logitech is a technology company. They do have consumer-facing products. If you're ever, unsure of what industry a company is in, you can go over to seekingalpha.com and you can type in the ticker symbol and you go under financials and overview, and you can see the sector or the industry here and see if it's a technology company, a consumer company. That'll help you out. All right, let's take a look at your next slice here in your industrials. You have 8. Waste management, great. Raytheon, great. Ecolab, this is a materials company. So Ecolab is a materials company. 3M, great. Union Pacific, great. Lockheed Martin, great. Delta Airlines, okay, great. I think you're going to do fine. My favorite here, I really like Waste Management. I like 3M. I really like Lockheed Martin. These are really strong companies. Let's take a look at your healthcare slice. You got MDT, great. Pfizer, Johnson & Johnson, United Healthcare, Merck, AbbVie, and Amgen. I personally think that Johnson & Johnson is the best quality here of the bunch here. Johnson & Johnson, in my opinion, should be at the highest percentage, the highest allocation in your portfolio here. I really like Pfizer. I like MDT. You're going to notice that these these companies, these healthcare companies, they pay a good dividend. A lot of them are a lot of them are 3, 4, in some cases you can get 5%. If you bought into AbbVie last year, you might have even got a 7% dividend. I mean, these pay really good dividends. Utilities, you got 4 in here. You got Nextra Energy, you got Dominion, you got Southern, and you got Duke. Yeah, this is great. These are really, really good. Technology, you got Visa, Microsoft, Western Digital, Broadcom, and Cisco. Yeah, I think this is fine. Like, there's a lot of big brand names in here. One thing that to be aware of, right, when it comes to your time horizon, if you're really looking at 20 or 30 years, I think this is completely fine. Just understand, right, like with Visa, you're not getting much of a dividend. Like, this is absolutely a dividend growth company. They grow their dividend 10+% year over year. And I mean, even with the pandemic, I don't think here in 2020, I don't see them slowing down anytime soon. If you compare that with Microsoft, also really just a 1% dividend yield, very, very low. If you compare it to like Broadcom, it's night and day when it comes to the current yield. And so this is really, really important, right? You're looking at your time horizon, you're looking at the current yield, and you're looking at the growth rate. It would take Visa and Microsoft years. It'd take Visa decades to get to the current yield of Broadcom. And, given that Broadcom is still growing its dividend year over year. So it's something to keep in mind when you're setting up your target allocation. Let's take a look at your finance slice here. You got 5 holdings, you got Main Street, you got JP Morgan, you got T. Rowe, Aflac, Bank of America. These are great. These are well-established companies. There's really nothing wrong with the target allocation. You're skewing it a little bit more towards your monthly dividend payers, but I mean, for the most part, I mean, these are really, really good companies. If you look into telecom, you got 2 with AT&T and Verizon. I mean, you cannot go wrong with AT&T and Verizon when looking at the telecom sector. So these are great. So Steve, you said that you're investing between $1,000 and $1,500 a month in your portfolio. You're not going to take 20 years to reach early retirement. It all depends on your expenses. If you have high expenses, then yeah, it's going to take you longer. But if you're able to cut your expenses, cut your consumer debt, and earn more money, right? You're investing $1,000 to $1,500 a month now. Maybe in 7 years, 10 years, you bump that up to $2,000. 2,500, right? Maybe you get a side hustle and you start doing more things on the weekend, or you buy a house like like we were talking about earlier, and you find out a way to make that work, right? There's so many different things that you can do, and really it comes down to hustle. If you want to make it happen, you can make it happen. And I'm so excited that you're starting to think about this, that you're doing it now. I mean, you might think, yeah, I'm 34 years old, I'm late to the game. I mean, when we both compare ourselves to the 16-year-old that we just looked at earlier, man, I feel old and unaccomplished. But, for the rest of us, for us normal human beings, and not this, crazy advanced, whatever you want to call them, 16-year-old that's unbelievable and just remarkable. I think for us in our 30s, right, staying motivated, side hustling where we can, and setting ourselves a goal and sticking to it, and not discouraging ourselves. Don't get discouraged thinking, okay, well, I should have started earlier, right? Obviously, the best time to have started was yesterday. The second best time to start is today. And I think you're off to a great start. I would definitely recommend taking a look at your monthly payers. Understand, okay, is this really what I want to do? Do I want to focus on more monthly payers? I really like investing into companies that have a great track record of growth, of paying their dividends. They're, environmentally and socially responsible, investing for my future into those type of companies. Also, what I would recommend you do is take a look at some ETFs. Take a look at some high quality ETFs. I think VYM from Vanguard and SCHD from Schwab would make a great addition to your portfolio. Also, another ETF that I really, really like is DGRO from iShares. Great dividend growth ETF. That would be my suggestion, is take a look at some really, really high quality ETFs. I think that they would make a really, really great addition to your portfolio. Thank you everybody so much for watching the video. If you're new to the channel, I'd invite you to subscribe. If you liked today's video, give me a thumbs up, and I will catch everybody in the next video.